Welcome to the first ever edition of Rubin on Tax on video. Today's topic relates to gifting of property that is appreciated or encumbered, and two particular income tax issues that relate to that. This is particularly important in this time period, late 2012, where a lot of gifting is going on to take advantage of the large unified credit before it's scheduled to be reduced significantly in 2013 and thereafter. The first issue that we're going to talk about is one that's out there and commonly being discussed, but is important nonetheless. If you make a gift of appreciated property, the recipient receives a basis in the property equal to what the donor's basis is. However, if the donor instead retained that property until he or she passed away, the basis would be adjusted to fair market value. So what this means is if the property is appreciated in value and it is held until death, that gain gets wiped out. But if you give the property away during your lifetime, that gain is not wiped out and carries over to be taxed in the hands of the recipient. The second issue is an issue that's probably not being discussed very much, though it's worthy of discussion, and that relates to transfers of encumbered property. Again, a lot of the gifts that are being made right now involve gifts of limited liability company interests or partnership interests. If those entities have borrowed money, then their liabilities are generally allocable amongst their members or partners. And if a member or partner then gifts away an interest in that LLC or partnership, they are deemed to have disposed of the property for that share of the liabilities. If that share of the liabilities exceeds the basis of the donor, then you can have gain on a gift transaction. How do you end up in this situation, which is commonly referred to as a negative capital account situation? One circumstance where this develops is just a typical operating real estate holding company or other business where deductions are taken and basis is reduced in the interests of the owners as the deductions accrue. If the amount of the debt stays steady, that is, it's not paid down, but the basis of the interest drops with these deductions, this differential is where you can have gain on disposition, even by gift. Similarly, if the partnership or limited liability company borrowed funds and distributed that cash then to its members, their basis again drops and you again have this differential or gain situation. Now this situation it can be deferred or potentially avoided forever by making the transfer to a grantor trust, which a lot of the transfers going on today are. However, you need to be cautious that if the grantor trust status terminates, for example, by the beneficiary dying and an outright distribution or a non-grantor trust continuation, then you could have gain then if that occurs while the donor is still living. So these are two particular areas that you do want to pay attention to in regard to making gifting of property. See you next time.